So that brings us neatly on to Reasons to be Cheerful, Part 2. I'm sure we all enjoyed the first one, but we've got the second one now on three very different subjects. If I can invite Seb, Eloise, and Mike up to the stage, please. I really wanted the focus to be not trying to hide and run away from or pretend that everything's perfect, because it isn't, as I keep saying, but there is still a massive, really good stuff going on. So we're going to hear from three people who know a lot about their subjects, a lot of experience, and I'm going to invite Seb really to talk first, if that's okay. Does that make sense? With opportunities in EVs today, I believe. So would you like to introduce yourself and then your subject? You've got about 6 minutes. Do you want to stand up? I think it's quite nice if you stand up, but it's entirely up to you.
Good afternoon, everybody. So my name is Seb Beloe. I'm a managing director at a company called Foresight, previously of Web. And I'm going to talk to you about electric vehicles. Actually, I feel quite cheerful already. I don't know about anybody else. I mean, I think the purpose of these sessions was to make sure that we all felt cheerful, but it's been very cheering, I think, all the way through, so even exciting. So anyway, I'll add a bit more optimism, even if you don't need it. So yes, I'm going to talk about electric vehicles. Some of you may be aware that there was a big week a few weeks ago in New York called Climate Week. It was actually the largest event that they've hosted. They had over 1,000 scheduled events during the week. And there was one piece of research that we received from an investment bank afterwards, which was trying to summarize the key messages that came out of the week. And I just wanted to read it to you. The headline was "More Data, Less Doom." And it said, there is a disconnect between the reality, brackets positive, and narrative, brackets negative, around many elements of climate and energy and the energy transition. In their decision-making and capital allocation, investors and companies should spend more time understanding underlying data and ignore the persistently negative vibes. That was the kind of headline of this piece from this investment bank. And I think it's true, and we've been hearing this across the day, it's true across much of our agenda, but I think it's particularly pronounced in electric vehicles, where this disconnect between the narrative and the reality on the progress of electric vehicles has been particularly galling, I think. You see anti-electric vehicle stories in the press pretty much every day, and it's got so bad that actually the House of Lords published a report asking the government to take action to counter the misinformation. So I don't know whether what you feel the story is around electric vehicles, but I'm going to give you some ammunition to, in terms of numbers, to correct that if it's a negative. Of course, there are challenges. Just at the end of September, President Trump terminated the federal tax credit that they were providing of $7,500 if you wanted to buy an electric car in America. They basically gave you $7,500 to buy it. So that's almost certainly going to slow the penetration of EVs in the States. In the UK, still today, most electric cars are more expensive to buy than their internal combustion engine equivalent. You pay more upfront for those cars. But actually, the overall picture is much brighter than you might realize. And I'm going to give you, I wish I'd talked to Solitaire before this session, because I've got a couple of stories, but I've got a lot of numbers. So I've slightly given vent to my internal nerd about the numbers that I'm going to give you. But I think they're quite extraordinary. So in the UK, 1 in 5 electric cars are now, they retail for less than the average price of an internal combustion engine car. So there are vehicles available. It's not just luxury cars. There are now cars available across the different segments of the market. And in most cases, electric cars are dramatically cheaper to run than an internal combustion engine car. So when you think about the total cost of ownership, which includes the price you pay and then the cost of actually running a car, it's actually cheaper to own an electric car today if you can charge it, if you have your own plug where you can charge it. I can actually charge my own car, which has about 250 miles range, for under £10. So it is really cheap to run electric cars. And just sticking with the UK, one final statistic. In early October last year, so a year ago, 17% of all new cars sold in the UK were battery electric cars. This year to date, it's 22%, and the number that we got just at the end of September was 23%. So you've jumped from 17 to 23% in just a year, and that's just fully electric. If you include plug-in hybrid electric cars, you get to 36%. So over 1 in 3 cars now is either a plug-in or a battery electric vehicle. But the real story, as we've heard in other sessions today, is really in China. And also increasingly in other developing countries. The sales of EVs in China last year were larger than the whole car market in the US. So they sold more EVs in China than the entire US car market. Well over 50% of all new cars sold in China are electric cars now. And because China's got such a large car manufacturing industry, they are selling these cars around the world. Actually, the UK is now the largest export market for Chinese cars, for electric cars. They're up 880% in a year. You'll see more and more of these cars around. BYD is a particularly popular brand. But it's not just China. In Nepal, 70% of all new cars are now electric cars. In Thailand, it's 60%. Vietnam, it's 40%. And this traditional narrative of it being sort of a luxury item that slowly gets more affordable has been completely inverted by the Chinese. So if you're trying to buy a new car, starter car in any of these countries, you'll choose an electric car because it's the cheaper option. It's cheaper to buy, and it's much cheaper to run in these countries. And we're also, just in terms of what does this all mean, ultimately it's really about reducing oil use. In the most advanced electric vehicle market, which is Norway, where more than 90% of all cars now are electric cars, new cars sold are electric cars, we're now seeing a 3 to 4% drop in petrol use, liquid fuel demand per year in Norway now, 3 to 4%. It's not long before that really adds up, which is a bit ironic given Norway actually produces quite a lot of oil. And then the other source on this is Sinopec, which is China's largest distributor of petrol and diesel. And they reckon that China will reach peak demand for petrol this year, and diesel will be a few years later. It's a bit slower in the truck market to introduce electric cars. And as an environmentalist, of course, I think this is tremendously good news. But in truth, it's not really happening quickly enough. The peak that we're seeing is more like a kind of Scottish Monroe. It's rather sort of round, whereas actually what we really need is sort of Matterhorn with a really dramatic decline. And we really need that dramatic decline if we're going to meet our 2-degree target. Already 1.5 is far gone. But as an investor as well, just my final point here, we invest in many of the companies that are making these components that go into these electric vehicles and that are benefiting from this growth. And they're generally not expensive to buy, these companies. The valuations are not excessive. And in fact, when you look at the valuations as a whole across the sustainable investment market, they're really extremely attractive. If you look at our portfolio, the web portfolio, it's now trading at valuations it's actually just come off the bottom, but it's still, we haven't seen these valuations for 10 years. So it is an extremely attractive asset class, if I can call it that, sustainable investing. And I think with a lot of growth to come, as we're already beginning to see, and this disconnect between the narrative and the numbers, I think creates a real opportunity to invest in these kinds of companies. So thank you very much.
Fantastic. Thank you, Seb. Eloise, would you like to maybe introduce yourself and your subject? Thank you.
Sure. Hi, everyone. I'm Eloise Robinson, and I lead on the Sustainable Universal Map Range of Funds at Columbia Threadneedle Investments. So as you've been hearing about today, I think there are so many exciting developments and areas within sustainable investments to feel cheerful about. And so many companies out there that offer both a compelling sustainability thesis and investment thesis. Now, I want to take the next sort of 5 minutes or so to just talk through one example of these, which is a name we hold in our fund, which I think is in both a really exciting area and is itself a highly innovative company. And this is Intuitive Surgical, and they are a global leader in robotic-assisted surgery, or RAS systems. Now, if we firstly think about robotic surgery more broadly, more generally from a sustainability perspective, I think it offers many positive outcomes, both for the patients, but also for surgeons as well. For patients, it can help reduce the invasiveness of surgery. So this effectively means the reduced size of incision, so therefore lower chances of complications like bleeding or infection, just due to the increased precision that these robotic systems can offer. This means a smoother recovery process, so therefore a likely shorter hospital stay, and this means less burden and cost on healthcare systems. In Intuitive's 2024 ESG report, they highlighted the 2024 COMPARE study, and this was one of thousands of publications produced that year that looked at some of the benefits that these systems can offer. And within this particular study, it demonstrated that one of Intuitive's key offerings, which is called the Da Vinci Surgical Assisted System, this delivered really differentiated results compared to the next best minimally invasive surgical option, which is a laparoscopy or keyhole surgery for those of you like me that are less medically inclined. So what this study showed was actually these robotic systems offer shorter recovery times and compared to keyhole, result in a transition to open surgery 56% less. These systems also resulted in 75% fewer blood transfusions, 29% lower readmissions rates, and also almost a 2-day shorter hospital stay compared to open surgery. Now, if we think about some of the benefits for the surgeons themselves, these systems can help support the training of new surgeons by allowing them to practice complex procedures in a more controlled environment. They can also help improve the efficiency of procedures and also help reduce the physical demands of long and complex surgeries for surgeons. Clearly a better outcome for them, if they're spending less time kneeling over the operating table, you've got a reduced risk of fatigue, neck pain, back pain, etc. Now, currently, less than 10% of annual global surgical volumes use these types of systems, these robotics. So clearly there's like a huge growth opportunity there, which is something that's really, really exciting. If we turn now to Intuitive itself, this company is a leader within this robotic space. And I think a big driver of that is due to its intuitive nature. So for example, in 2024, the company released its most advanced system yet, which was called the Da Vinci 5. And this has 10,000 times more processing power compared to its previous generation 4 system. What has this meant? So you've seen a greater incorporation of digital tools, things like integrated 3D modeling, and also something that's called force feedback capability, which means that the surgeons, whilst they're doing this surgery, they can actually feel and measure the pressure that these robotics are exerting on the tissue, which is pretty incredible. The company, it's everywhere at the minute, but it's also leveraging AI, also to help assist surgeons with things like real-time predictive data analysis. And all of this helps further reduce the risk of complications and leads to better patient outcomes. Now, these Da Vinci systems are the most widely used surgical robotic systems in the world. So, to date, since they've been around, over 16 million procedures have used these systems. And not only has this resulted in positive health outcomes for patients, it also helps provide and build a growing body of evidence of the benefits and uses of these systems, which hopefully will help support greater adoption going forward. Now, obviously, within sustainable funds, we want to invest in companies, invest in names that have that compelling sustainability story, but also they need a compelling investment case, and I think Intuitive offers both of these. From an investment perspective, the robotic-assisted surgery industry clearly has very high barriers to entry, and also tremendous scope to grow. The company is so focused on that innovation and its innovative nature, means it has been able to sustain its market dominance and hopefully should be able to do so going forward. In terms of sustainability, clearly when we think about it, its products align with UN SDG 3, good health and well-being. And they're also focused on their quintuple aim around better patient outcomes, better patient experiences, better care team experiences, and expanded access to care, and also a lower total cost of care and reduced duration of hospital admission. So just to conclude, I think the opportunities in the space are vast, the benefits are huge, especially given the currently low adoption and use of these systems compared to all surgical volumes globally. So there's clearly huge scope for growth. And therefore, within that, I think Intuitive Surgical, is a really exciting name, and that gives me reason to be cheerful. Thank you.
Thank you, Eloise. And finally, final word from our external speakers anyway to Mike. Floor is yours.
Thank you very much. Good afternoon. So I want to talk about sustainable investment and investment performance, because we've seen this is clearly critical to how many people are going to be into it. If you're going to be underperforming, there will be some people in those funds, but not very many, and it won't be mainstreamed. And I want to address this myth that sustainable investment underperforms. All of it underperforms and is doing so now. It's never really done very well in the past, and it's highly unlikely to do well in the future. So what I'd like to just draw out some general points. I'm not going to talk about our specific funds. I'm going to try and draw out some general bits. Let's talk about equities, which is where a lot of the money is invested in. That's where the weight is. And let's talk about those sustainable investment equity strategies that have a bias towards mid-size growth companies, which is not all of them, but lots of them tend to have that, because that is where a lot of these innovative companies that are coming up with these solutions sit within the market cap. And just very quickly, if we go back to 2022, if you were growth, you were basically struggling to get anywhere near what the market returned on average, and that's because interest rates went from basically 0 to 5, and the more value you had in the future, the worse you were affected in terms of your valuation today as a result of this going up. So growth massively underperformed during that period. And then since then, what we've seen, particularly in the US, which is a large part of global markets, but a similar thing happening in the UK as well, is that the market has been led by very large companies. A lot of them, not all of them, related to artificial intelligence, and the market has almost all its bandwidth has been taken up with thinking about this huge spend that's happening in AI, and a lot of money has been going into those. And so if you were a mid-cap company that maybe had these companies are underrepresented in your fund, your equity performance has been really quite poor. I just want to speak up a little bit for a different asset class, so sustainable bond strategies. It is possible to find sustainable bond strategies that have delivered really good investment performance through this period that we've been talking about, that are first or second quartile over pretty much all time periods going back 15 years. So it's not the case that all sustainable investment has done very well, but it is true that a large bit of the equity bit has suffered largely because of that, that mid-cap growth thing that's been going on. So if we think longer term and trying to take on board the fascinating thing earlier on, if we look at Janet here, who 12 years ago invested in a sustainable fund, and despite this period of poor performance recently, she has made a little bit more money than she would have done investing in a conventional, what the average fund did. So over that time period, she's very happy. And then on her right, we've got Brian, who's only been invested in these funds for, I'm making this up, 8 years, and his investment returns are slightly lower than what he would have got in a conventional fund. But he's very excited about the engagement that's gone on his behalf with those companies, and he's very excited about the investments that are going in to make his children's lives better. The point I'm trying to make is longer term, it is possible to find sustainable investment strategies that have delivered very comparable, if not better, investment returns than investing in conventional non-sustainable funds. And hereby comes into the bit where I get excited about it. Now, that's the past. There's nothing we can do about it. Those numbers have been written. But where are we today? If I've got a bucket of money that I want to deploy into the market today, what sort of areas am I going to be deploying it into? And forgive me, some of you heard me say this yesterday. I'll try and say it slightly better than I did yesterday. But the idea is that these, within the equity mid-cap growth companies, they look really cheap. They look very compelling. They've seldom ever been as cheap as they are relative to the rest of the market. And those two things that have made the investment performance headwinds for these strategies in the past, that mid-cap and that growth aspect, are the very things that make them very compelling investment opportunities going forward, given the market will start to broaden out and look for areas of the market that are undervalued, and that is a really interesting investment opportunity going forward. And I'm sure that in 5-7 years' time, we'll be looking back and thinking what a great opportunity that was to buy many of these stocks that we have been talking about today on very undemanding valuations. I'm going to stop there.
I'm sure there's some profound statement I ought to be able to make about the past being a different place or something, probably some profound quote from Shrek or something, but I can't think of it. I think those are really interesting and giving really different aspects, sort of a social and environmental, and then talking about performance. Never a truer word's been said. You know, the past is the past, the future. We've seen so many trends. We've talked about waves. We've talked about what's happening going forwards. We've talked about all these sectors that are just taking off. The future is where we've got to be looking for sure, and I think it's very bright. And I'll come to questions first, but just to say the reason we've had this pushback is because of our success, right, to a large extent. So that's why we're getting attacked, and ESG was so much attracted so much criticism. But just in the last couple of minutes of this session, then, can I ask if there's any questions? Because you've got some very capable people here, who are very knowledgeable on this subject, doing it a very long time. Certainly, two of you, Eloise. I suspect you're a little bit younger. So any questions, please? One over here. Thank you.
Yeah, I've got a question for Mike. You said that a lot of the opportunities were in mid-cap equities and performance has been poor. Have they kind of fallen out of mid-cap, gone to small-cap? And then as a result of that, has there been a lot of consolidation, or are you anticipating that is to come and we'll see more sort of mergers and acquisitions? And just finally, has the sort of situation deterred exciting new companies to list? And therefore, are they just staying in the private sphere?
Hello. Let me try and answer that. So just to put, when I talk about mid-cap, I'm talking about in the context of the whole market. So these are pretty big companies. You know, they might be 10, 50 billion market cap. And they're slightly smaller than they were a few years ago, but they're certainly not micro cap or tiny companies anymore. They're still very big, profitable, generally companies that are going forward. So we're not seeing that. In terms of, if you look at the market, almost all of the bandwidth has been about AI and about the big hyperscalers and the huge amounts of capex they're putting in, and about sort of secondary derivatives of that. And there hasn't been a lot of companies buying smaller companies that I'm aware of. There are some notable exceptions in the UK where there are some of the much smaller companies have been bought. And I think in terms of new companies coming to the market, I think generally they want a buoyant market and they want people to be confident about what's going on. And I don't need to remind you that, you know, with the Trump show going on, it's very hard to work out what's happening because the playbook, I mean, Trump is a very serious guy. We should take him seriously. But, you know, the playbook is he comes out, he says something very dramatic, the market fills their nappy, puts in the worst possible scenario. 3 weeks later, someone comes up to Trump and goes, oh, well, maybe we should do this. And then things are worse than they were, but not nearly as bad as everyone thought. And so in that environment, I think it makes it quite difficult for lots of companies, and this isn't just about sustainability, but these tariffs are a nightmare for companies to work out. If you're a company and you've got, I don't know, 30,000 different products that come from different countries, trying to work out the way in which you're going to navigate it. So I think it's been an unhelpful time, and that's why there haven't been a huge number of new companies coming. But what I would say is that there are no lack of really interesting companies that are out there. It's not like we're desperate for something new to come along. We think that there are a really interesting opportunity set of companies already available. We welcome new ones. I hope I answered your question, but Seb, you've probably got a better answer than me on that. I don't know if you've got any thoughts.
I mean, the only thing I would add is, you know, in terms of, it doesn't really address the question directly, but in terms of this context, the market concentration now is at, again, unprecedented levels. I think previously it was like, I can't remember the exact figure, I think 25% or something of the market is concentrated into the top 10 stocks or something, and now it's like 39%, or it's, you know, it's mid-30s. So we are at, you know, we are absolutely due a correction, and to see this market broadening out again, it's another kind of data point that I think points to change is kind of overdue, really.
I think we had JP Morgan making that point this morning, didn't we? Jamie Dimon, I think, on Radio 4, while they were quoting him saying, correction possibly nearer than people are thinking. Eloise, did you want to add anything to that, or should we go for it? Sorry, it looks like Mike. Yes.
Unfortunately, no one can say when that's going to happen. Because I've been saying this for a couple of years now. But we do believe that patients will be rewarded. We think that these are very good quality companies that are doing really good positive things. And, you know, we think they're on sale right now, and you should get involved.
Any more questions at all before we wrap up? One over here. Zoe, yeah, thanks.
Hi, my name is Simon Wardley. I'm an advisor. My question is for Eloise, actually. Thank you for that talk on robotic surgery. And so not that I ever am going to be a stock picker or anything like that, but occasionally like to throw out stories like that to clients, why you're investing. Well, actually, clients know why they're investing, but it's really great when we have a catch-up to pick stories and particular funds and highlight them myself. I've got to try and second-guess a question that I would get asked back by a client, for example. So a lot of innovation and the thing you were talking about there, might that go to exactly the wrong kind of people? You know, a lot of technology benefits rich people in the West. Is a lot of this surgery just going to be focused on fixing knees of rich 80-year-olds and things like that? I think we spend a lot of time trying to get people to 95 in good health or something like that, ignoring the great swathe of the world that can't reach the age of 5. I know surgery is not going to be the answer to death in childbirth necessarily at that point. But could you expound, or do you know a bit more about that you could quickly share about how that is going to benefit the wider world, you know, the kind of world we need to get to adulthood?
I mean, I think with this company, you know, they do have a lot of research. They're spending a lot of money on research in terms of broadening out the types of surgeries that they can do with these systems. So you know, at the minute, the study that I mentioned was kind of focused on that versus keyhole, looking in kind of certain oncology areas. And they are still only in the process of rolling out this Da Vinci 5 system. So far, I believe it's only hospitals in the US, but they are then looking to broaden that out to other areas in the US and also globally. So I think it is definitely something to be aware of. And, you know, there are obviously big health inequalities out there in the world, but I think a lot of these technology companies in this space are aware of this, and it is definitely on their radar and something they're trying to kind of work with and improve.
I mean, if I could just add that I think it's a really interesting company, and I think it does address, if you're thinking that it takes you a long time to get an operation here, if you've got, you know, a surgeon, bluntly, who, that's a terrible pun, but a surgeon who can do 6 operations in a day instead of 4 as a result of this equipment, you know, there are a lot of people that are going to benefit from that. And I also think it's a very good point, what you said. I mean, one of the things we forget is the incredible progress that's been made over time in things. We never read about it in the press because it's not that important. But if you think about infant mortality, which are children that don't make it to 5 years old, you know, we've gone from 1/5 of people dying before their 5th birthday down to a fraction of 1%. And a lot of that's to do with sanitation, but also a lot of that is to do with vaccines. It's an incredibly exciting time. And if you think what happened in COVID and us being able to come up with a vaccine in 9 months for something new, all that required gene sequencing, which costs, you know, a few $100s to do each time. But when it started, that whole research program cost something like $1.5 billion. And it's these companies that are innovating and distributing these things at scale that are enabling this innovation that does go right the way across. And you know, things like vaccines are a very cost-effective way of being able to treat people for a very long time for a relatively cheap price. So I think it's one of many different types of sort of innovations in healthcare that different funds. I can't talk about all funds, but I just sort of, my experience of those different things, it is important to have that as well. But there's a role for both those kinds of companies. A lot of the real
innovation starts at the top end. Think about astronauts, and then you've got non-stick frying pans. I mean, that's a bit of a crass example, but you know, stuff finds its way through, doesn't it, over time quite often. That's not as interesting as robotics and what have you. But I think on those grounds, because we've run over, and I let that run over because I thought that was really interesting, and I will wrap up my session more quickly. Can I just ask you to thank these guys first, please? Thank you.